This is one of my favorite questions. How important is timing in the market? Should an incoming client/investor worry about timing the market, or should he shift his burden to the PM and let him decide when and how to invest? More so, how does alder decide on when to enter a stock at what price? Could you give some perspective on that?
So it's my favorite answer as well. So we consider our universe to have type A and type B businesses. Type B businesses are those which are mediocre or just about good. Why do we call them as mediocre and good? Is because they don't have serious pricing power or maybe a market share or a brand where they can actually scale, right? And the customer side of it, the demand side of it might not be as strong as we would desire. In a large basis, these businesses tend to have lower return ratios, lower market shares, lower history of gain in market shares, and maybe managers who are not future ready or not scaling up the businesses in the desired manner. So we call these as mediocre type B businesses. And there are type A businesses where you have all of these, right? The managers are a highly productive culture where innovation, where they're able to expand opportunity size sets and scale the business much faster than the peer group, right? But at a cost or return on investments which are far better than the markets and the peer groups, because they have the pricing power in a bigger sense. So we have type A and type B businesses. Type A businesses, what we call it as great businesses, and type B businesses, what we call it as good and mediocre businesses, right? The question comes back to market timing. If you are going to be buying type B businesses, right, then you definitely need to time the market, because what typically happens in a market down cycle, we get to see that people generally tend to sell out on the type B businesses just as a blanket, right? Whether it's mutual funds or FIs. The falls are even dramatic because many people believe that in an adverse market situation or an adverse business cycle, these type B businesses will be impacted the most. They have least pricing power. They will be impacted by, let's say, high inflationary pressures. They'll be impacted by high interest costs and the likes, right? As you keep going on and on and on. Whereas in type A businesses, markets don't really sell them because they feel that, it might be selling pressure because somebody wants to exit India, or somebody wants to create a cash, or somebody wants to just hoard up cash saying that I'll wait for the rainy day. But the point is that they're not selling it because of the fundamental flaws in these businesses, and therein the fall is relatively less. So what happens in these type A businesses is after the brief fall, they tend to recover faster because the earnings are accelerating in an adverse market. And that comes back to the earlier question I had, was the Super 70 list. Those businesses which tend to outperform even in a bad cycle, right? So what our philosophy is simple: do not time the market. And this was not a philosophy that I had when I started managing assets, by the way, I'll be very honest. It took us time to learn. And I think after the 4th year, we slowly realized that while we were great in timing markets, we realized that we couldn't time the markets when the markets were at the bottom most, because markets are most opaque at that stage, right? You could time the markets at the top most because you feel the valuations are at an absurd level and something else is happening. But either case, it's very difficult to time the markets. But we realized that the reward of not timing the markets and holding on to great businesses, you pay less to the government in terms of taxes, you sleep better at night, right? And at the end of the day, the power of compounding takes care of itself. So our entire efforts have actually been to try and seek type A businesses and do away with this type B businesses and market timings. So life becomes a lot more simpler.
This is really interesting perspective on timing that sir just shared, because maximum portfolio managers that I've come across either believe in remaining fully invested, and I think this is more like a hybrid version where if you know that you are investing into type A businesses, it might be much easier to enter into them.